I cannot tell you how often I hear from clients and listeners alike asking, does it really make sense to get a 15-year mortgage versus a 30-year mortgage? Well, I think the answer is yes. Now, it does not mean if you're listening and you can't afford the payment on a 15-year mortgage, well, don't even give it a second thought. Don't feel like you need to get a 15-year mortgage because Mr. Cleve on the radio says 15-year mortgages are the way to go. But let's take a look at some specifics. If you were going to buy a $300,000 house in Atlanta, and let's say you were going to put 20% down, you were getting a $240,000 mortgage. Today's market rate, now this is going to sound different. If you're out there shopping for a mortgage, I'm going to tell you that the market rate on a 30-year fixed mortgage today is 3.21%. Now, that 3.21% would come with an average 0.9% origination fee. If you amortize that payment over 30 years, the monthly principal and interest payment would be $1,039. You would also have some additional payments every month for property taxes and insurance, and if you added all that together, your payment would be $1,372. Now, let's take a look at that same scenario, but with a 15-year mortgage. Well, if we look at the Freddie Mac average 15-year rate from throughout the country, now this also includes some additional loan origination fee, it would be 2.62%. You heard me right, 2.62% for a 15-year fixed-rate mortgage. Now, that is with 0.8% in fees. So, but if we look at that $240,000 loan amount, 2.62% interest amortized over 15 years, the principal and interest payment is $1,613. For those of you who can't remember, the payment on the 30-year mortgage is $1,039 a month. The monthly payment on the 15-year is $1,613. So let's just call that about $600 different. It's a little less than $600, but you're paying $600 a month every month. If you add in the property taxes and the insurance, you'd come up with a principal, interest, taxes, and insurance payment on the 15-year loan of $1,947. Sounds pretty good. Let's take a look at 5 years from now, 60 months from now. For the 30-year mortgage, you would still have an outstanding balance of $214,000. And listen to this, you would have paid $36,538 in interest over those 60 months, over that 5-year period. Now let's take a look at that 15-year mortgage. At the end of 60 months or 5 years, you would have an outstanding principal balance of $170,211. So you would owe $44,000 less on your home in 5 years than if you had a 15-year mortgage than if you had a 30-year mortgage. But over a 30-year mortgage on that $240,000 loan, you would pay $134,124 in interest. On the 15-year loan, which means you'd make 180 payments over 15 years, you would pay a total of $50,499 in interest. Now, if we look at those numbers and we take the difference, that's almost $84,000 less in interest paid. I don't know about any of you, but I never have thought it was part of my responsibility to make sure that the banks and the lenders and the investors get rich in this country. I have always thought it was more of my responsibility to make sure that my family had good financial security. So I say $84,000 is lots and lots of reasons. Actually, it's 84,000 reasons to get a 15-year mortgage versus a 30-year mortgage.